Hi YouTube, it's Janelle here, and in this video I'm going to be updating an old video that I posted a couple years ago that desperately needs updating. A few different things have changed in the past couple years and it is just about time for us to get a fresh new video up. So we're going to be talking about mutual funds, index funds, and ETFs. In 1929, the first mutual fund was created, which was open to the general public. Investors could pour money into this mutual fund, purchase shares of the mutual fund, and by purchasing these shares, they would get access to all of the companies inside of that fund. Now, it's pretty common knowledge today that that's how most 401ks and 403bs and IRA accounts that invest for retirement, they all pretty much have mutual funds in them. So it's very common today. But once upon a time, that wasn't the case. The thing that people love the most about mutual funds is that they make investing really easy, and they also come with automatic diversification with hundreds of companies. Now, the more companies that are in the mutual fund, the more diversified it is, and the more diversification, the lower the risk that you take as an investor. That means it's less likely that you're going to lose your money, which is a good thing for us as investors. We want to try and minimize risk when we're investing so that we don't have to freak out whenever the market is not doing so well. But who picks the companies that are in a mutual fund? Traditionally, there's been a mutual fund manager doing all this activity. They have to research and analyze companies and financial statements and compare them to make the best choice for the mutual fund. So what they're doing is pretty much trying to predict which companies are going to have the most growth in the future and put shares of those companies inside the mutual fund. But the reality is that doing all that work ain't free. It costs a lot of money to have actively managed mutual funds, which come with an active mutual fund manager. The average fee that you'll pay on an annual basis, so you pay this about once per year on all assets that you have invested. That means what you've contributed plus any profits or earnings that you've made, add it all up together, and this is what you pay on that. This is a percentage fee every year on mutual funds, and it's called an expense ratio. Right now, it's about 0.6 to 0.8% on average. Compounding returns is great. We love that because that means more profit for us. But compounding fees and costs is not something that most investors want to deal with. So you want to try to get your fees to be as low as possible on an annual basis so that you maximize the amount of money that you actually get to keep. Okay, so mutual funds made things a lot easier and come with automatic diversification, but the active mutual fund manager that's making all the decisions and doing all that work is getting a little too pricey. So that's where we come in with index funds. The first index fund was created in 1976 by John Bogle or Jack Bogle at the Vanguard Group. This is why you hear about Vanguard so many times when you research index funds or mutual funds, because the very first index fund was created by Vanguard. Index funds are mutual funds, but they're a special type of mutual fund that does not have an active mutual fund manager doing all the work. That person is going to get the boot. The companies that you're going to be investing in when you choose to invest in an index fund are all going to come off of a list that has been pre-created. So you don't have to do any work to choose your investments, to choose the companies and the stocks that you want to invest in, and neither does an active mutual fund manager. The other word you can use instead of saying list is index, which is why these special mutual funds have a special name, index funds. Some famous indexes or indices that you probably already heard of are S&P 500, the Dow Jones Industrial Average or the Dow, Russell 2000, Vanguard Total Stock Market. These are all lists with all of the companies in there that have met a certain criteria or have certain qualifications that make them eligible to even be on these lists. Okay, so since index funds no longer need that active mutual fund manager to do all that extra work, they're going to be cheaper to invest in compared to traditional mutual funds. But how much cheaper? That average drops down to 0.04 to 0.1. So this is a very big difference. We're talking about 6 to 8 times less. Why would you pay $80 for something when you can get the exact same thing for $10? Actually, for the first time in history, in the summer of 2019, more money was invested in index funds compared to traditional and actively managed mutual funds. And that was all over the news. But there's definitely a lot of things about mutual funds and index funds that some investors straight up do not like. And one example is that you cannot buy or sell a share of a mutual fund or an index fund more than once in a trading day. And the reason why is because when you purchase a share of a mutual fund, you won't find out the price that you're paying for that purchase until the end of the trading day, when the NAV, or net asset value, of that mutual fund or index fund gets calculated. So essentially, you can only make a purchase once, and then you have to wait to the end of the day to find out what the price of that transaction was. Now, a lot of investors really don't like that, because investors are used to being able to buy and sell and then rebuy and resell and trade stocks on the exchange all throughout the trading day. And that's where ETFs come in. In 1993, the first ETF was born, and that stands for Exchange Traded Fund. So it's like a mutual fund or an index fund because it has all these different companies in one bundle, but it can actually be traded on a stock exchange. That's why it's called an Exchange Traded Fund. Mutual funds and index funds cannot be traded throughout the trading day. Exchange traded funds can. And that is a very big structural difference between these two different types of investment funds. Mutual funds and index funds on one side, ETFs on the other. Now, some other reasons why ETFs might be more desirable to investors, besides the fact that they can be traded on an exchange all throughout the trading day, is the fact that they have a little bit more tax efficiency than a mutual fund or an index fund would. And the reason why is because when you own mutual funds or index funds, throughout the time that you're holding those investments, you'll be getting distributions paid out to you, or you might get the distributions at the end of the year. But when you file your taxes, you have to pay taxes on those distributions. The only way that you would have to pay taxes when you own ETFs is when you sell your shares of your ETFs. Tradability and tax efficiency are two of the main reasons why so many investors love investing in ETFs. But there's another benefit to them as well. And that's when you're investing and you're getting started and you're choosing between mutual funds versus ETFs, sometimes it comes down to how much money you can actually afford to get started with when you're investing. And when you look at mutual funds and index funds, the amount you need to be able to get started investing in shares of these funds is a flat dollar amount. Usually that's like $1,000 or $3,000 or sometimes even more. It just depends on which mutual fund or which index fund you're considering. But when it comes to ETFs, the amount of money that you need to get started is much lower because you only need to be able to afford one share of that ETF. And the share price of ETFs can usually be as low as $75 or $95. It really depends on which ETF we're talking about. But generally, it's going to be much more affordable to get started investing with ETFs than it would be if you want to start with mutual funds. ETFs have one downside to them where mutual funds have a leg up. And that's the fact that with ETFs, you cannot automate your withdrawals or your contributions. So if you want to automate your investments so that you don't have to worry about it, you don't have to think about it, and it's nice and easy, you would put automatic recurring investments in your account. So that means you don't have to worry about it. When you get paid, your money just gets moved into the account and purchases more shares. But that's not possible with ETFs. You actually have to manually purchase more shares or manually sell shares if you want to withdraw money, which is really a negative thing when you consider how many people like to automate their finances and make things easy for themselves. That's pretty much everything you need to know to make the decision about whether you want to start with mutual funds, index funds, or ETFs. But if you have questions or comments, thoughts, reactions, drop them in the comment section below. I will definitely try my best to respond to as many comments as I can. And that's pretty much all I have for you in this video. So till next time, peace.